I've built a $7 million portfolio in just under 7 years. I've bought almost 50 properties for other investors apart from myself. So I've seen a thing or two, and I've seen what actually does drive growth and what doesn't. Spoiler alert, it's not what most people think. I see people all the time chasing the wrong metrics. They're chasing population growth, infrastructure spending. Where's the nearest shopping center? Where is the nearest train station? Where's the nearest local school? And while those things might seem important on face value, those people end up with assets that do nothing for years. And that sort of stagnation is what actually costs you hundreds of thousands of dollars in opportunity cost. So without further ado, let's talk about which types of suburbs to avoid and the data that actually does predict capital growth. Now, before we get into that list, here are the things that I see most people get wrong. Most investors are buying with their emotions, or they're buying with hearsay, or what Uncle Joe said at the barbecue. Remember, all these people, it's all hearsay, right? We don't know if they bought property 4, 5, 6, 7 years ago. Of course they've done well, but we need to dive into the nuance. Their circumstances, where they bought, they probably bought in their own backyard. It's very different to what you're having to do today to make money from property investing. The second thing is they chase the next hotspot or the next infrastructure boom, or this is where the next project is. Remember that if you're buying, especially if you're buying in capital cities, almost every suburb has schools, shops, public transport. Those types of things do not separate winners from losers. Yes, they might matter in super regional locations. And why are there often suburbs that have none of those things that outperform the rest? The logic just doesn't stack up. The truth is, the ones that do well are often the ones that don't actually look that special. Nothing stands out in a crazy way from the outside looking in. And here's my thoughts on long-term thinking. To me, it's overrated. You cannot draw equity and reinvest from an asset that's done nothing for 4 years. Those that are able to invest 1, 2, 3 years sooner every time they reinvest back into the market, those people end up much better off in the long run. And the medium run for that matter. So here are the 5 worst types of suburbs. Do not invest in these. Number 1, suburbs that have already boomed, already at the top of their cycle, already about to hit 12 o'clock. They're at 11 o'clock right here on the property clock. Do not invest there. The run is already done. You're buying at the tip of the cycle. And remember, a significant proportion of the people that are buying property are not just investors, they're owner occupiers. And these people eventually will run out of wages and income and money to support these exorbitant property prices. Beware. Do not buy at this point in the cycle. Prices are too disconnected from local incomes. If you invest here, you're going to have years of flat growth before the next cycle kicks off. And ain't nobody got time for that. So ignore last year's top performers, I beg you. Find the suburbs that haven't yet moved, that have tight supply and strong owner-occupier demand. That is the recipe for success. Now, onto the important stuff. Before you do anything, grab my before you buy checklist. It's basically just a framework I use to test suburbs step by step. The link is below. You can follow along while you watch if you like. Number 2, second most worst type of suburbs to buy in. The super cheap suburbs, or the low-income renter belt. This stuff feels like a bargain. Oh my God, it's $350,000. How could you possibly go wrong? I'll tell you how you can go wrong. Buying a property that's not going to move for years and years. Oh, it's paying itself off. Cool story, mate. We want capital growth here. We're in the accumulation phase of our journey. Growth is the only thing that matters. Cheap does not mean it's a good opportunity. These are usually low-income, investor-dominated pockets that are simply a recipe for disaster. I recently had someone who bought something super regional, super cheap. It's been on the market for rent for 6 weeks now. There is an influx of investor properties that have been bought, and there is so much rental stock on the market. She is $4,000 or $5,000 out of pocket at this point and is just desperate to get the property rented out. That's just one of the reasons. So remember that it's the owner-occupiers who drive the growth, right? The investors don't overpay, they buy with logic. Owner-occupiers buy with emotion, and they drive prices up. If you wanted to buy a house to live in, you're probably going to pay more than if it was an investment, right? And people always talk about, oh, but these suburbs or these areas gentrify. Yes, they may gentrify, but it takes 10, 15 plus years for these areas to really gentrify, and they're high risk. But they're high risk of no gentrification happening simply because they're at such a low price bracket. The price indicates the amount of demand that has been historically in that area. People don't want to live there if prices are $350,000. Otherwise, there'd be more than that. So check your owner-occupier ratio. If it's heavily dominated by investors, if there are less than 60 or 70% owner-occupiers in a suburb, run for the hills. And remember that we want to play in markets that have emotional owner-occupier or home buyers, not just investors. Number 3, we want to avoid high supply locations. Supply is very, very, very difficult to fix. Demand can change overnight, right? New government policy, new rules and regulations, demand can shift overnight. All in all, supply, very hard to fix. That is why we look for established low supply first. So avoid new estates, avoid brand new apartments or high density residential zoned apartment areas. Avoid all the shiny brochures and the nice finishes. It might feel like growth and oh my God, there's so much happening here and there's new shops and there's new apartments, but it's just construction. Just think of it like they're just building stuff and you're going to be the one paying the price. Ultimately, too much stock means not a lot of competition and zero pricing power. There is no pressure on prices to increase because there is no competition. If you're looking in Zetland or Alexandria or Mascot, and there are hundreds of apartments just like the one you're looking at a Saturday inspection, why would you pay overs for this one? For the one you've just come and inspected? No, you're going to drive the agent down on price, or you're going to go and look at the one around the corner that may be slightly nicer or slightly newer. Developers will always keep pumping this supply to sell it to investors. The end result is price stagnation, it's rental competition, and ultimately it's discounting of those properties, meaning no price growth. So check your stock on market percentages, check the inventory levels of an area, and make sure that supply is tight. If the listings are rising and they're just sitting there, avoid that market like the plague. That is your warning sign. And remember that established suburbs with low turnover, meaning people are holding their properties for a long time, low supply, those are the areas that will outperform the market every single time. Number 4, avoid the hype suburbs. The ones that have the new projects, the new infrastructure, the new hospital. Those things may be important, but they are not the reason why you decide to invest in a suburb. Oh, there's a new train line coming, there's a new Westfield, there's a new hospital, a new school getting built, a new army base. These are not things that I look out for at all. These projects can be delayed, they could be cancelled, they may not have any real impact whatsoever. The reality is that infrastructure is everywhere. It's happening everywhere, every corner. Every council has their 2032 vision, and you're going to be able to find that wherever you go. It's no longer a differentiator. It is the property data and the supply and demand metrics that drive the growth, not the hype around these projects, this infrastructure, the local whatever. That stuff does not drive growth. The supply and demand data does. And yes, by all means, use infrastructure as a reason, use it as a bonus, but not the reason. It's a great bonus to have a new hospital coming in. The supply and demand data stacks up, ticks all the boxes, and they're building a new hospital, we're winning. Satisfy the supply and demand criteria first, then use your infrastructure or your projects as a bonus or as a cherry on top. Number 5, don't buy in investor-heavy or dominated locations. A lot of people think, oh, if other investors are buying there, it must be good. And to a certain extent, that can apply. But we don't want too many investors. We still want owner-occupied dominated locations because investors don't overpay and owner-occupiers do, and that's what we want for price growth. Investors equal no emotion, no bidding wars, and no price growth. These investor-heavy locations are also very dangerous. The problem is that these investors, say they make up 50% of the stock in a suburb, they're not going to be selling their home when they lose their job, I'll tell you that much. They're going to be selling their investment properties first. So above all, these suburbs are a huge supply risk, massive. And I don't invest in them because I don't just think about the good times, right? Everyone's a genius in a bull market, but what about the downturns? What happens when times aren't all that snazzy? I don't want to be stuck in a market where prices are plummeting. So remember that the healthy mix is about 70% owner-occupiers or homeowners, 30% investors. That is going to be a good recipe for capital growth. And it's going to protect your downside too. There's only 30% of people that are investors in that market. So if the market shits the bed or there's a downturn, you haven't got majority investors in that market. You've got mostly owners who are going to hold onto their homes for dear life, meaning it should protect the prices in that suburb and they shouldn't plummet. So those are the 5 types of suburbs you want to be avoiding in 2026. But that's only half the game, really. The real question is, where should I buy, JP? So in the next video, I'm going to show you exactly where I would buy if I had $100,000 today.